You've heard it a million times. Invest early, build wealth, retire rich. But nobody tells you where to actually begin or how not to mess up. And when every expert throws around jargon and hype, it's easy to freeze. So here's the real question. How can a beginner start dividend investing without getting lost? In this video, I'm going to tell you and John all about what dividend investing really means and why it's not just for Wall Street pros, what to avoid. And in the end, I'll show you dividend investment options that can turn your $10 a day investment into a $3 million portfolio that pays over $30,000 in monthly dividend income. So let's get going. Dividend investing is all about getting paid just for holding on to certain stocks. When a company makes a profit, it can choose to share some of that money with its shareholders. That shared profit is called a dividend. Some companies pay cash dividends, actual money deposited into your account. Others might offer extra shares of stock, which can also grow in value. Occasionally, you'll see one-off special dividends when companies do really well or sell off a big asset. So why does this matter for you? Because dividend investing isn't just about buying, it's about earning while you hold. And that's where it starts to get exciting, especially when you see how these payouts can snowball over time. Let's be real, watching the stock market go up and down can feel like a roller coaster. One day you're up, the next you're wondering if you should have just kept your money in a savings account. But dividend investing, it adds something solid to your strategy. Actual income paid regularly, no matter what the market's doing. Here's why that matters. Unlike other ways of investing where you only win by selling your stocks for more than you paid, dividend investing lets you earn without selling a thing. The company shares its profits with you, often every quarter, just for being a shareholder. That income can be used however you want. You can pocket it as cash, or better yet, reinvest it. When you reinvest those dividends, you buy more shares. More shares means more dividends next time, and the cycle keeps growing like a snowball rolling downhill, gaining size and speed. Here's a simple example to understand the snowball effect. Let's say you invest $1,000 into a dividend-paying stock or ETF with a 4% dividend yield. That means in the first year, you'd earn $40 in dividends. Now here's where the magic happens. Instead of taking that $40 and spending it, you reinvest it, using it to buy more shares of the same investment. So now, in year 2, you're not just earning dividends on your original $1,000, you're also earning on the $40 you added. By the end of year 2, you'll have earned around $41.60 in dividends. It's only a slight bump, but it's growing. Reinvest again, and in year 3, your new total is earning dividends too. You're up to about $43.23, and that keeps repeating year after year. The more shares you own, the more dividends you get. The more dividends you reinvest, the more shares you own, and the cycle keeps accelerating. It might not look dramatic in the first few years, but give it time, and just like a snowball that starts small and grows bigger with every turn, your portfolio will start picking up serious momentum. Another bonus is that dividends can help protect your buying power against inflation. Many solid companies increase their dividend payments over time, which can be seen by a metric called dividend growth rate. So as prices rise in the real world, your income from dividends grows too, which helps your money keep up with life's rising costs. It's not just about stability or income, it's about momentum. And for beginners, it's a brilliant way to get started without the stress of market timing or complicated trades. Okay, now that you've seen how powerful dividends can be, let's look at why they're especially great for beginners just starting out. If you're new to investing, the idea of throwing your money into the stock market can feel a bit intimidating. But dividend investing takes a lot of that fear off the table. It's a path that's slower, steadier, and best of all, more forgiving for beginners. One of the biggest advantages? Lower volatility. Dividend-paying companies are often large, established businesses with a history of solid performance. They're not chasing risky growth. They're focused on staying strong and returning profits to shareholders. That means less drama when the markets get shaky and more peace of mind for you. Then there's simplicity. Many of these companies have easy-to-understand business models. A great example is a REIT, a real estate investment trust, like the ones that own shopping centers or office buildings. Their job is to generate steady income and pay it back to you. Simple, predictable, and effective. Plus, starting small is easier than ever. You don't need thousands of dollars. You can buy dividend-paying stocks, exchange-traded funds, or ETFs in tiny pieces, known as fractional shares, even with as little as $10. There are ETFs built specifically for dividend investing, giving you instant diversification and a solid foundation to grow from. And here's the best part. At the end of this video, I'll show you a real portfolio, one that could generate over $30,000 in dividends alone if held long-term with just a $10 daily investment. But before we get there, let's make sure you understand the basics that make all of this work, because while dividend investing is simple, knowing a few key terms and metrics can help you make way smarter decisions and avoid beginner slip-ups. Alright, before you start picking dividend stocks or ETFs, it helps to understand a few simple numbers. These are the key things investors look at to figure out whether a dividend is reliable, sustainable, and worth your money. First up is the dividend yield. Think of it as your return on income. If a stock is $100 and pays $3 a year in dividends, that's a 3% yield. Most beginners are tempted by higher yields like 8% or 10%. But here's the catch, high yield doesn't always mean high quality. In fact, too high can be a red flag that the company is struggling or can't maintain the payout. It might mean the stock price has dropped a lot because the company's in trouble or that the dividend isn't sustainable. So instead of thinking higher is better, you want to think strong and steady wins the race. Next is something called the payout ratio. This tells you how much of the company's profits are being paid out as dividends. If they earn $1 per share and give you 70 cents as a dividend, that's a 70% payout ratio. A good rule of thumb? You want this number to be under 70%. Why? Because companies still need to keep some of their profits to reinvest in growth, pay down debt, and stay healthy. If they're handing out every dollar they make, that dividend might not last. Then there's the dividend growth history, and this one's pretty straightforward. Has the company been consistently increasing its dividend every year? That's a great sign. It shows they're not only committed to rewarding shareholders, but also strong enough financially to keep doing it. A solid 5, 10, or even 25-year track record says a lot about the company's financial strength. You're looking for reliability, not just a quick payout. And finally, there's a slightly more advanced one called distance to default. Sounds fancy, but it just means how close is this company to running into serious financial trouble. It takes into account things like how much debt they have and how stable their earnings are. Big investment firms use it to spot red flags before things go south. You don't have to become an expert overnight, but it's good to know tools like this exist, and some platforms will actually show you this info if you look for it. So with these tools in your pocket, you're ready to start building a smart, income-producing portfolio. Let's walk through exactly how to get started step by step. Now that you've got the basics down, it's time to actually put things into motion. Don't worry, getting started with dividend investing is way easier than it sounds. Here's a simple 6-step plan to go from interested to invested, even if today is your very first time. Step 1. Know what you're investing for. This is your starting point. What's the goal here? Are you hoping for a little extra money each quarter, something to help cover bills, or treat yourself now and then? Are you playing the long game, building a future nest egg for retirement, freedom, or just peace of mind? There's no wrong answer, but your goal will help guide which types of dividend investments make the most sense for you. If it's income now, you might lean toward higher yield stocks. If it's growth later, you might go for companies with smaller yields but a strong history of raising dividends over time. Step 2. Choose a brokerage platform that fits your style. Think of this like picking the right toolbox. You need a brokerage account to actually buy investments. If you like doing things yourself and want control over what you buy, platforms like Fidelity, Schwab, or Vanguard are solid, beginner-friendly options. If you'd rather set it and forget it, consider a robo-advisor, something like Betterment or Wealthfront, which can build a dividend-focused portfolio for you based on your goals. Step 3. Open your account. This step sounds more complicated than it is. It takes about 10 to 20 minutes to open your account. You don't need to go to a bank or talk to anyone on the phone. Just head to the broker's website or app, and it'll guide you through the steps. You'll fill out some basic info, name, address, and things like your social security number or national insurance if you're in the UK. You'll also choose what kind of account you want. For most people, that'll either be a regular brokerage account or a tax-advantaged one like an IRA in the US or an ISA in the UK. Step 4. Choose your investments, the fun part. Now comes the part where you actually pick what you invest in. You've got two main choices: individual dividend-paying stocks or dividend-focused ETFs, which are bundles of stocks put together. Big names like Johnson & Johnson, Coca-Cola, or Procter & Gamble are popular because they've been paying and growing dividends for decades. But if you'd rather keep things simple and let the ETF do the diversifying for you, check out funds like SCHD, the Schwab US Dividend Equity ETF, or DURA, the VanEck Durable Dividend ETF. You can start with one or mix and match. Totally up to you. Step 5. Turn on dividend reinvestment. This part matters. Most brokerages let you turn on something called DRIP. That stands for Dividend Reinvestment Plan. What it does is super smart. Whenever you earn dividends, they automatically get used to buy more shares of that same investment. No need to log in or click anything. It's set it and forget it growth. And because you're buying more shares, you'll earn more dividends next time. That's the snowball we talked about earlier, getting bigger with every roll. Step 6. Start small, even if it's only with $1. Seriously, that's not a gimmick. Thanks to fractional shares, you can now buy a small slice of a stock or ETF with literally $1. You don't have to wait until you've saved enough. The real magic of dividend investing isn't how much you start with, it's how early and how consistently you keep going. A little today, a little more next week. That's how you build wealth. Now, in a couple of minutes, I'll show you dividend investment options using the same steps that can turn your $10 a day investment into a $3 million portfolio that pays over $30,000 in monthly dividend income. But before you make that first click to invest, let's take a second to talk about something just as important: what not to do. Avoiding common traps can save you a lot of frustration and money down the road. Starting something new is exciting, but it's also easy to stumble into traps without even realizing it. With dividend investing, the biggest risk isn't losing everything overnight, it's slowly walking into the wrong choices that don't pay off. One of the most common mistakes: chasing high yields. If you see a company offering an 11% dividend yield, it might sound amazing, but that high number could be a warning sign. It often means the company is under pressure and may not be able to keep paying that amount much longer. High yield without financial strength is like a car going fast with no brakes. Another mistake is relying only on a company's past. Just because a company has paid dividends for 20 years doesn't mean it'll keep doing so forever. Always check its current financials, debt levels, and earnings. Look forward, not just backward. Then there's overpaying for popular dividend stocks. Look, when a stock gets hyped up, stocks can rise too high, and if you buy at the top, your returns could suffer even when the company stays strong. It's okay to wait for a fair price. And finally, ignoring the balance sheet. A business might look great on the outside, but if it's loaded with debt or not generating real profits, its dividend is at risk. The good news is, those beginner traps, they're easy to dodge once you know what to look for. And now, you do. So the next question becomes, what happens when you actually stick with this? You've picked your goal, you've opened your account, you've chosen solid investments with strong fundamentals. You've even turned on dividend reinvestment and started putting in a little bit, consistently. Let's say John has a simple goal: grow steady wealth over time without stressing about stock charts or market timing. He decides to invest $10 a day, just enough to skip a fancy coffee or two, and he sticks to it. That's $3,650 a year into a carefully selected dividend portfolio consisting of Goldman Sachs, a strong dividend payer with consistent capital gains, KB Home, known for aggressive dividend growth, the Schwab US Dividend Equity ETF offering reliable yield and diversification, and the iShares Core Dividend Growth ETF, focused on companies growing their payouts year after year. Together, these picks create a balanced portfolio that averages a 2.49% forward dividend yield. That means if John invests $100, he's earning $2.49 in dividends right now. But here's the best part, this portfolio also has a 16.8% average dividend growth rate. So that payout is designed to grow fast, and with an estimated 10.27% annual return from share appreciation, his wealth is also growing year after year. But what do these numbers actually mean over time? Let's play it out. After 5 years, this portfolio will be valued at $23,778. By year 10, it'll be valued at around $70,397. Fast forward to year 20, and it'll reach $408,873. That's when the compounding effect kicks in, and every couple of years, the investment amount grows significantly because of the added shares. Which means by year 30, John's portfolio will reach a massive $3,132,316. By that time, the portfolio will be paying around $386,667 in annual dividend income, or $32,222 a month in dividend income. Now, if you're sitting there thinking there's no way this is possible, look back at Warren Buffett's Coca-Cola position. In the 1980s, he bought 400,000 shares worth $1.3 billion. Now, that same investment pays over $700 million in dividends every year. So the portfolio numbers aren't far-fetched, it's just how dividend investing works. It compounds and eventually pays more than you invested over time. And here's the breakdown of the portfolio. Almost $1.6 million of that total came from reinvested dividends alone. Another $1.3 million from appreciation, and all of it built on a total contribution of just $109,500 over 3 decades. And this is exactly why dividend investing isn't just a good idea, it's one of the most powerful, accessible ways to build lasting wealth without needing to be a stock market genius. Want to get paid every week, starting next week? Click the video on the screen to find out.